Hi, just started coughing as soon as I made started this video, sorry. This problem I'm going to work 15-7A, and I have the problem pulled up. It's an important problem, not only for the homework, but also to understand. Then on the test, problems in general, you could be asked about one of the variances and not all the variances. You need to be able to identify which one you're being asked about. This one, we're asked about volume variances first. Actually, in A and B, we're asked to do volume variance and label it as favorable or unfavorable. It says to use the information in 15-2. So let's slide up there now and look at 15-2. The budget is based on 2,000 units, and they actually produced 2,200 units. Sales price is $12, and the variable cost is $7.20 per unit. We'll come back to this in a minute. So again, we were asked, where did it go? I always look at the learning objectives. I don't know if y'all do that or not, and I always slide down too far. Sales and variable cost, and label them favorable or unfavorable. Let's switch over. We have the solutions here, and this is how they work it. And this might be how you're getting feedback and connect. That's not how I work mine. Let's look at how I work mine. In a prior video over Check Yourself 15.2, I wrote down and explained my abbreviations for these. Please watch that video if you haven't yet. So standard price times standard quantity, and standard price times actual quantity is the volume variance. And that's all we were asked to work, so that's all I'm going to work. The standard price, according to what we just looked at in exercise 15-2, was $12. The standard quantity was 2,000. They ended up selling more units. They sold 2,200 units. Good for them. So 12 times 2,000 is 24,000. 12 times 2,200 is 26,400. Now, normally, if this is an expense, I'd say budget was 24,000. The actual expense is 20, or the standard base, the expense. The standard cost based on actual quantity was 26,400, unfavorable. But that's not what happened. They sold more. I think that's good. Dig in a little bit deeper, we might find out that, for whatever reason, it wasn't a good thing. But they kept the price the same. They didn't lower it, and they grew volume. I'm going with favorable. Okay, so that's the answer there, favorable. Now let's tidy up everything and let's work the variable cost, the variable manufacturing cost. That was sales, and then we're going to work variable manufacturing. So V-MFG, variable manufacturing. God, that's a lot of abbreviating, isn't it? All right, I think it was $7.20, right? $7.20 a unit. I believe so. I'm not going to flip over because I'm pretty confident of it. $7.20. Now, if this was a test or if I was doing homework and I hadn't practiced this a couple of times, I would always refer back to the source document. Standard quantity was, I had a flashback to the problem before this one, 2,000 units. And standard price, $7.20 times actual quantity, which was 2,200. And calculating the difference between these two will give us the volume variance for variable manufacturing. Now, there's two ways you can work this. You can do 720 times 2,000, and you get 14,400. That's the way we've been doing it on every one. And then I just worked it, and I'll be honest with you, I know you can't see it, but I can't read my handwriting. So I just recalculated it on my calculator. All right, so 15,840 is that one. And then you get a difference. And in that case, 15,840 minus 14,400. I'm using the calculator, you get 14,400. Now, I'm going to say it's you, and I'm going to explain it, and then I'm going to show you another way to calculate 1440. So cost isn't higher. That's it. Cost is higher. That's the reason. That's the reason it's unfavorable. But it is non-informational. Total variable cost increased because of volume. That's it. That's the reason. There's nothing anyone can do. We think it's a good thing sales went up. We're happy. That means variable costs went up. We're happy. That's just the way it is. Now, it would have been great if, somehow or another we increased sales, but it took less materials. We weren't given that information. Okay. If we said, okay, the actual price that we were paying wasn't $7.20 but was $7 an hour, that would be the price variance. We're just looking at the volume variance, 2,000 and 2,200. So unfortunately, even though this is really it's not meaningless, but it has no real true unfavorable or favorable. If we had to say it's unfavorable or favorable, cost is higher, we're going to go with unfavorable. That's it. That's A and B. How about that? All right. I'm going to tell you to pause right now and read this section. So go ahead and pause and read it. I just covered it closely. And now it says, let's go to the book. D and E. Let's look at them together. D and E. Determine the fixed cost that will appear in the flexible budget. Determine the fixed cost per unit based on planned activity, and the fixed cost per unit based on actual activity. Assuming Cherokee uses the information from a master budget price to price the company's product, comment on how the fixed volume variance could affect the company's profitability. Round computations to 2 decimal points. Let's grab the fixed costs from exercise 15-2 if you haven't already. So fixed manufacturing is 3,600. So fixed manufacturing is 3,600 and fixed selling and admin is 1,200. Oh, I switched over. Yeah, there we go. All right. So we just looked them up, and that's the answer to D. The fixed cost for the flexible budget is 3,600 for manufacturing, fixed manufacturing, and 1,200 for fixed selling and admin. Now, no matter what the volume is, it's going to remain 1,200 as long as it's in the relevant range. 1,200 and 3,600 as long as it's in the relevant range, no matter the volume. E said, though, calculate the cost per unit. Well, as volume increases, fixed costs per unit go down. So we already looked up 3,600 and 1,200. If you add them together, you get 4,800. Divide that by the budgeted volume of 2,000. The fixed cost per unit, all fixed costs per unit, is $2.40. If the volume increases to 2,200 and nothing else changes, it's now 4,800 divided by 2,200 instead of 2,000. So now on the flexible budget, our fixed cost per unit is $2.18. Now, I'm going to go a little different route than the book. If the 2,200 is not sustainable, like it's just a great year, we're going to remember it for decades to come, but the normal range is 2,000 units. We can't price based on 218. If we do, we're pricing our product too low. Okay? We had a great year. It's an exception. We need to keep pricing it based on the 240 with the fixed cost in the 240, right? However, let's say 2,200 is just the beginning of great things to come. Our competition is also increasing volume. Everybody in the industry is increasing volume. Fixed cost per unit is dropping. If we keep pricing our products thinking that our fixed cost per unit is 240, when our competition is going ahead and lowered prices some, and they're pricing their product at 218, then their prices are lower. They could be taking market share while we're keeping our prices high, thinking it's 240 when it's actually 218. All right, so I showed you both sides of the coin, right? What happens if the 2,200 is a one-off? How does that affect pricing? Don't go 218, stay with the 240. If we're going to continue to increase volume and 2,200 is likely to continue for the foreseeable future, maybe even go down, we've got to reflect that new reality of a lower fixed cost per unit. right? And if we don't, we will lose market share to competitors because they're going to go ahead and say, we can lower our price, maintain profitability, maybe even increase, right? So what we need to do is be cognizant of what's going on in the industry. So a lot of times this stuff that we're learning and pricing and how important costs are, our competition's doing it also. And they're doing a great job at it, and they might be doing something better. They may have learned something about their costs and been able to lower prices. And then their company is much, much more profitable than we are. So it's a good thing to know and understand how this affects everything in the company. It's not just an accounting decision, but working with marketing and management, the C-suite, everybody. It's a team effort. It's just not a one-off that the accounting department does. If you have any questions on this problem, please give me a call, email me. Thank you.